Well, hello once again, options traders, and this is the second in a three-part series of rolling out options early. In the last one, we talked about at-the-money options. This is going to be for in-the-money, and then the last will be for the out-of-the-money. So the question is, should you roll out an in-the-money option early? Well, as always, there's lots of things to consider, so let's go take a look. And as always, before we do, please be sure to click like and subscribe. It definitely helps to promote the channel and is always very much appreciated. So quick recap, remember what rolling out is. It means that we are rolling out in time. We are increasing the time to expiration on our option. If we are rolling in, we are coming to a closer dated option. And then the terms up and down refer to the strikes. So rolling up means that you're rolling to a higher strike. Rolling down means that you're rolling to a lower strike. So whenever you hear the terms in and out, it always refers to time. So when you're rolling out, we are assuming that you are keeping the strike of your current option the same. So maybe you own the $100 call, you're going to keep the 100 call, but you just want to go maybe from January to March. That would be rolling out. And the question that we're trying to answer is, should you ever do that early? As always, there are trade-offs in every single trade that you make. Every single option that you add, change, go from long to short is going to change your risk graphs, and it changes the risk-reward relationships. No strategy can dominate another for all stock prices and for all aspects. So that's what makes it a hard question. It really depends on what your assumptions are and what you're trying to do. But here's an example of rolling out an in-the-money option. Let's say the stock is at 100 and you own the 30-day $95 call. And the question is, should you roll it out? You've still got 30 days until expiration. Now, the reason that people often think that they should is that they're thinking, okay, it's going to start going off the steep part of that time decay curve. And they go, I just don't want to watch it bleed away quickly. So let me roll out from the 30-day to maybe the 90-day. Well, as I've often talked about before, remember that theta really isn't a risk. It's a characteristic of an option, and that's because time moves in one direction at one speed. We know that in 30 days, that 30 days will have passed. There's no mystery there. So it's not really a risk, but that's really kind of a separate issue, which I've talked about before, but just keep that in mind. Just because you're thinking that you're about to go off the steep part of that time decay curve doesn't mean that you necessarily have to roll out. The questions that you have to answer, what are the trade-offs? So for rolling an in-the-money option out early, here are the pros. You will increase your vega. That's always going to be true whenever you're going out in time because longer dated options are more sensitive to volatility. However, as I talked about in the at-the-money video, this is really a weak argument. You would need a really big change in volatility to really see any kind of a significant change, but that is a possibility. You will also decrease your theta. This is probably the biggest reason why people want to do it. They say my option again is about to go off the steep part of the decay curve, so let me roll it out and I can slow down this rate of decay. So those would be among the pros for rolling an in-the-money option out early. What about the cons? Well, you're going to decrease your deltas because an in-the-money option with more time to go is less likely to expire in the money. And if you remember that delta is roughly the approximate probability for an option to expire in the money, that should shed some light on it. The more time you have to go till expiration, the less likely it is to stay in the money. So that would be one of the cons, that you're going to have a smaller delta and you're also going to increase the price of the option. That's always going to be true when you're rolling out, just because you're keeping the strike the same and going out to a longer date. And so this is probably the biggest thing to be fearful of, is that you are going to increase that option's price. So let's go take a look at some pricing models. And as before, this is a 30-day and 120-day option for a 95 strike with the stock at 100. So it's just 5 points in the money. Take a look at our deltas. We have an 81 delta if we're holding the 30-day, but if we roll out to the 120-day, we drop it from 81 to 68. So if you're presumably still bullish, which is why you're either holding the option or considering rolling out, why would you want to drop from an 81 delta to 68? Take a look at theta. You had a 3 cent theta losing 3 cents per day, at least right now for the 30-day option. And if you roll out, yes, you can decrease your theta a little bit. It's going to drop to minus 0.02 or about 2 cents. But look at your Vega. That's going to go from 0.08 to 0.21. That's what I mentioned before. That could be a possibility if you thought there was going to be some kind of an explosion in volatility. But then you also have to ask, volatility, remember, is non-directional. If you're thinking volatility is going to get big, a lot of times that means it's more to the downside. At least that's when we get the biggest pops in volatility. And here you are holding a call. So if you really think things are about to get super volatile, you have to question the merits of even holding the call in the first place. Saying that you're going to have more exposure to Vega isn't going to do you a whole lot of good when the stock is down 20 or 30%. But then the biggest con, as always, is that you're moving up in the cost of that option. Your current option is worth $5.64. Remember, this is the 95 strike with the stock at 100. So it has 5 points of intrinsic value and 64 cents of extrinsic. The 120-day call also has $5 of intrinsic, but it has $2.60 of extrinsic. And that's what's causing it to bleed away at a slower rate. Yeah, you've got more extrinsic, but you've also got 4 times the amount of time. So again, this is why it can be a little bit of a misperception. You might see that the theta is lowered, but you've also increased the cost of that option. And if the stock moves against you, your maximum loss used to be $5.64, now it's $7.60, roughly another $2. And so you have to really question if that's worth it just to get a potential bump in Vega and a small change in your theta. So here are the two current curves. This is what we looked at in the At the Money video. The red curve is 30 days until expiration. This is the current curve, just showing the various profits and losses across various stock prices. The blue curve, same idea, it's the 95 strike, but with 120 days until expiration. So notice if you are on the red curve, the stock is at 100 and you've got the 95 call. So the stock's up here, 5 points in the money, and if the stock continues to run, the 30-day option will outperform the 120. That's why the red curve sits above the blue for all of these stock prices out here. And the reason for that is that the blue curve, the longer dated option, has more extrinsic value. And so it has to make up that extrinsic value before it can be as profitable. If the stock falls, now look what happens. Now your longer dated option actually underperforms. The blue curve sits below the red. So just as with the At the Money, if the stock makes a big move up, you're better off staying pat. Stay with the 30-day option. If it makes a big move down, you're better off staying with the 30-day because you'll lose less. But unlike the At the Money video, if the stock makes a small drop down here, remember the stock is currently at 100, but if it moves down to 95, you can see that the blue curve sits ever so slightly above the red. In other words, the longer dated option will start to outperform a little bit. But once again, you have to ask yourself, is it really worth spending the extra money when you could have a much bigger loss and you're going to have a much bigger opportunity cost if the stock rises, all in exchange for getting this ever so slight increase if the stock makes a small drop? That's really what the trade-off is. Now, also, as with the At the Money video, let's take the blue curve, whatever the options price is here at these various stock prices, and just subtract off the red curve. So you can think of this as two different traders. We're going to take the P&L of the trader in blue, and we're going to subtract off the P&L of the trader in red. And how will they compare? Well, if we do that, blue minus red, we get this graph. So take a look. Yes, now we can see that there's a little bit of a benefit if the stock is around here at 95, that little area right there. But you can also see it's far less than $1. But if the stock makes a big move up, we are doing worse by having moved to the longer dated option. And if the stock moves down, we are performing worse by moving to the longer dated option. So the main reason for rolling an in the money option out early is for just some reason that you wanted to have a little bit more profitability if the stock made a smaller move down. So otherwise, you're just going to be destroying your deltas and putting more money on the board, really for not much of a benefit. So just as with the At the Money, I would really avoid rolling an in the money option out early. But as we've talked about many times, I would certainly roll it up. If you've got enough time remaining and you can capture at least 80% of the difference in strikes, you always want to try to roll it up. But this video is talking about rolling it out. And in those cases, I would really rather not roll it out early, but instead wait until expiration. And also at that time, you'll have more information as to what the stock's going to do. You don't know what it's going to do in 30 days from now, but at that time at expiration, you will know. It will be whatever the current stock price is, and you'll be in a much better position to make a better decision as to which strike or expiration you should move to. So that's another reason for trying to avoid rolling it out early. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.